Finding the right real estate investment isn't just about buying property, it's about buying the right property. But if you get this wrong, you could end up draining all of your finances. In this video, I'm going to go through everything that's required to understand how to buy profitable, cash flowing properties and how to really get the most out of your investment. My name is Aguinaga. I'm a realtor here in Montreal with LJ Realties, and I've helped everybody from a first-time investor all the way to the seasoned professionals. So if you're looking to get into real estate investment and you want to have the best team in the market with you, reach out to me. All my contact information is down below. You can book a meeting directly with me, a one-on-one, and we can break down where you're at in your investment journey and how we can get you to where you want to go. So without further ado, let's get right into this. How do you identify a good investment property? Not all properties are good investments, and that's the harsh reality of the Montreal market. So one thing that I want you to focus on is cash flow. So what is cash flow? Let's start off with that. Cash flow is simply how much money is left over every month after you've paid your expenses. So it's how much revenue you're taking in, less all of your expenses, including your mortgage. That'll give you your cash flow. Now you want that number to be positive because that means that you have some left over. And depending on how severe your pro forma is or isn't, there could be more items on there that makes it a much more restricted cash flow, or there could be less items that kind of makes it seem a little bit inflated, if you will. The reality is you want to be realistic with yourself and with your pro forma. So include all the little things that sometimes are overlooked, like maintenance, like a reserve for appliances, like landscaping, all of these things that we don't typically put into pro forma. The more complete you are, the better prepared you're going to be to weather any storm. So a lot of times investors are looking at other numbers, but cash flow truly is one of the most important metrics, even in the Montreal market, because although we do really focus on appreciation in this market, cash flow is what's going to ensure that you're not going to be upside down when the going gets tough. So making sure that you're at least break even or ideally have a bit of cash flow moving forward in your direction is great. Now, I will say buyer beware in the sense that a lot of times I look at investments that are currently losing money, but I know that in the next 12 to 18 months, I'm going to turn them around. I'm going to make them significantly cash flow positive. So if you're looking at a property that is an optimization play and you're buying it today in a cash flow negative position, but you have a plan to get it to be cash flow positive in the next 12 to 18 months, then that's also acceptable because it's a different kind of play that also works into it. But again, ideally, and the goal always ends up being, make sure that you have a cash flowing asset in that 12 to 18 month window. And if you can do it off the hop, even better. But obviously some of the best deals out there require that bit of extra work to convert it into that cash flowing machine. The next thing I want you to focus on is market trends. So where is the population heading? I will typically say that young professionals know where the market is expanding to. And the reason for that is that they have a good sense for coffee shops, restaurants, amenities. They know where they want to be, and that's typically where the city is going to develop. So following that trend is a huge plus that you can do. The next thing that you can focus on is infrastructure projects. Where is the city investing dollars? Where are they creating new rec centers? Where are they investing into more services for the population? Wherever a city is investing dollars is typically a good sign that there's going to be more growth in that area, or that there already is growth that requires these services, and thus there's going to be more needs for real estate in the upcoming future. One more thing to consider when looking at market trends is vacancy rates. What areas have low vacancy rates? If you're not familiar with vacancy simply means what percentage of the units are currently vacant and therefore available for rent. The lower that number are, the higher the demand is going to be because obviously you have a very restricted supply. So when vacancy rates are low, and in Montreal in general, vacancy rates are quite low, we see that there's a huge jump in demand, and obviously we have to fulfill that, and therefore prices continue to go up, and we end up not really having vacant apartments, which as a landlord is the most important thing you can do, because every month that you lose in rent is a huge percentage of your income. Think about it. If you're renting your apartment right now for $2,000 a month and you were to lose 1 month's rent, well, that's, if I divide that over 12, we're talking about just under $200 a month. You could have accepted a rent of just under $200 a month less per month and ended up in that same situation. So making sure that you don't have vacancies is super important, and that's why looking at the vacancy rates preemptively is a great way to make sure you're investing in a good neighborhood. The next metrics you have to look at is your cap rate and your ROI, or return on investment. So let's start off with cap rate. What is a cap rate? Simply put, a cap rate is a rate that we use to compare how your investment fares compared to other ones in the same neighborhood. Now, different neighborhoods will have a cap rate so we can understand what properties are currently trading for. So in Montreal, generally speaking, we see cap rates between 4 to 5%. So let's use 5% for the sake of this example. How do we calculate it? Well, we take the net operating income, we divide that by the price, and if it's 5%, then you're in line with the market. If you end up paying a higher percentage there, so let's say that your cap rate is closer to 6%, that means that you're getting a good deal because you are paying less for a property that is generating more income. So again, that's how cap rates work in that regard. Now again, a lot of times in Montreal, if you are doing an optimization play, you're probably going to pay a worse cap rate. You might pay a 2 or 3% cap rate, knowing that there's a lot of upside potential and room for you to grow. So take that with a grain of salt, but cap rate is something that we look at. And we also kind of look at what it's going to look like in the market in the future. So we understand what's our evaluation going to look like when we do go to refinance, because the cap rate is what's effectively going to dictate how much our future valuation is. We can do that same formula backwards. What I mean by that is, let's say that we end up having a property that's generating $100,000 a year, and let's say that its net income is roughly $70,000 a year after paying its expenses. We will apply the cap rate to that by dividing that number, so 70,000 divided by 0.05, and that'll give us the estimated value of the building after the work has been done and after we've optimized it. So that's why understanding cap rates is important for the neighborhood, and it's super important to understand that it's not a blanket statement for all of Montreal. Different neighborhoods, different segments of the market will have different cap rates associated to them, so you have to stay in the know so that you don't miss out on potential opportunities. Next, ROI, return on investment. So that's basically states how much money are we making for the money that we invested, right? So if we look at this and let's say we invest $100,000 into a property, we want to know how much money are we getting out of that. Now, ROI can be looked at in a few different ways. We can look at our cash on cash return. So how much money are we getting out annually on that $100,000 that we invested? Or we can also look at it at how much we are getting from a cash flow perspective, how much are we getting in terms of appreciation, and we can also look at how much we've gotten in terms of capital pay down, because although you are paying the mortgage yourself, you're receiving rent to pay that off, obviously. We have to consider the capital portion. So when we make our mortgage payment, we have capital and we have interest. The interest is an expense. There's nothing we can do about that. But the capital portion is just paying down your debt. So when we really look at a complete ROI for real estate, you have to make sure that you're taking into account the cash on cash, the appreciation, and the capital pay down. So ROI is a big part of understanding how our real estate investments are working and what to do with them in the future. Next in this video, I want to talk about where you can find the best deals in Montreal and really in any market. All right. Now, the first place to go to, I know a lot of people laugh at this, is on the MLS. And I've bought, I think, 95% of my properties from the MLS. I have over 20 properties with over 76 stores. So a lot of times people don't believe me when I say that. But the reality is, I've taken the time to understand different neighborhoods and be able to spot a good opportunity where I can create value and truly optimize the property. So I will go through this, and I have investors who ask me to do this all the time, saying, hey, LJ, can you scan through everything that's available on MLS for me and let me know where you see opportunities? So I go property by property, I see what the current rents are, I see what the future rental potential is, and I start looking at pro forma so we can understand where we can really get a good deal. And every single time that I do this, we find at least 1, 2, sometimes 3 properties, and I'll sometimes send that to clients in our deal of the week. So if you're interested in being part of that community, I send one email out every single week. We call it our deal of the week. And if you are interested in that, you can then just email me back and I'll give you more information. So feel free to reach out to me if you want to be part of that. But the MLS is a great place to start. And a lot of times people laugh at it, and a lot of times people don't understand the real power of there, because you have a legitimate seller who's ready to transact on a property, and you can go in there and start negotiating a good deal on a property that makes sense, because a lot of times people haven't taken the time to understand the numbers, to understand the market, to understand the neighborhood, and therefore truly assess the potential of this property. The next place to find a deal is going to be off-market deals. Now, everyone usually gets really excited about off-market deals, but there's a little secret to them that really is not spoken about much, and a lot of times is kind of an ugly truth to them. Off-market deals can be amazing, but they can also be terrible. A lot of times people think they're getting an excellent deal because they're doing an off-market deal. But if they haven't truly understood the numbers, understood the neighborhood they're buying into, they might be overpaying for an asset. And because it is off market and they feel like it's something secretive, they think they're getting a deal simply because of that secretive factor. But I've seen a lot of properties that have been off market, and they stay off market because they know that if they were to go on market, they wouldn't generate any traction. They wouldn't have investors coming at them anyways. So they simply stay off market so that they don't burn the property. So you have to be very careful when you are dealing with off-market properties to make sure that you are doing your due diligence, you're running your pro formas, you're being very complete, because the fact that it's off-market means that you haven't gotten a third opinion from the general public to see if people are interested in this product. Now again, There are some excellent opportunities off market. You can be speaking to a neighbor, a friend, a family member, somebody that somebody else knows effectively that you heard of who's looking just to do a simple, fair transaction, and you can get an amazing property off market. So there are still opportunities there, but make sure that you do a full due diligence. The second you remove the brokers from the equation, the second you remove an extra layer of protection, you are exposing yourself to more risk. Another great option is having a buyer's broker who represents you, who's going to go out and look for these off-market deals for you. That means that they're going to start calling different neighborhoods. I've done it for clients in the past where we were looking for specific investment in a specific neighborhood. It was the Sudwest in this case. And I started pulling up the phone book and I was looking for every single plex that hadn't transacted in the last 10 plus years. And I started calling all the owners until I found a property that met the criteria for my client. So if you are looking for that kind of a service, please feel free to reach out. I'd be happy to have a great conversation with you and start doing that for you so we can really find you an investment that pans out with what you're looking for specifically and get you a true off-market deal where the numbers make sense. The next big opportunity to look at is distressed properties. Now, as the name suggests, distressed properties will come with their fair set of baggage. So what I mean by this, a distressed property is a property that is either in really rough shape, think that it's either been stripped or that it has a lot of leaks or a lot of plumbing issues or potentially it's had a fire, something of that nature. And when it is distressed, well, it has a couple of issues that come along with it because a lot of time banks, or traditional banks at least, aren't going to want to finance the property. So you might have to go with an alternative lender or a private lender, or you might have to purchase it in cash. Now, because of the restricted financing on these properties, you can typically find yourself getting a better deal on the property and therefore have a much greater return on the investment over the long run. This isn't for your starter investment. Really, you need to have some experience if you're going to go down this road, but if you are prepared for it, you can get an excellent deal on a property that way. Now, be prepared. There's obviously a lot of extra things to do when you're looking at a distressed property, but if you have some experience, you now have 1 or 2 properties under your belt, and you're looking to get your hands a little bit dirtier along the way, you can get an excellent deal on a distressed property because of the fact that it's distressed. Now, we just spoke about distressed in the sense that the property's in rough shape, but sometimes you have a distressed seller. And that's truly an excellent opportunity because if the seller has a strong need to sell and you can simply show up at the right time and give the person the terms that they're looking for in order for them to deal with their financial distress, then you can get an excellent property on an excellent asset. That's just a timing question in that regard. So distressed properties, all sorts of ranges, can be excellent deals. But again, like with every type of property, make sure you do your due diligence to avoid any issues down the road. Now, I thought it would be useful for us to run a calculation together so you could have an understanding of what a quick calculation could look like, and then we can discuss a few other items that you could add to it if you want to be more complete. So I'm pulling up one of my listings right now. We have this triplex. It's located in Lachine. It's on 7th Avenue. We're asking $874,000 for the property. It's got 3 units. You've got 4.5 and 2 5.5 units. The taxes on the property are quite low at $3,651. The rents are right now $1,500, $1,700, and $1,600. So great rents for the property across the board. And let's look at what the numbers would look like on this right now. So if we look over here, I've punched in the numbers and I've got 2 scenarios. So we've got scenario 1 where you're putting 20% down for the property, and I've got scenario 2 where you're buying it with 10% down. Now again, for scenario 2, you would need to be an owner occupant for the property, so we'd have to structure that a little bit differently, but we can look at what the cash flow situation is going to be like on this property. So I run it 874, 20%, that gives me $174,800 is my down payment. There's no CMHC fee because we're putting 20% down. I had the taxes that we just looked at a couple seconds ago, $3,651, and then I've used an insurance cost of $2,100. What I do for insurance costs for estimate purposes, I use $700 per unit, so 700 times 3 gives me this $2,100. And in this case, I'm using an amortization of 30 years because I put 20% down. I can go to 30 years. On these investments, I'll usually start off on a greater amortization in order to give myself a little bit more cash flow room early on. And I've used a rate of 4.3. You can probably get a slightly better rate in the market, but this just gives us an estimate of what we can do right now. So as you can see here, the rents that we had pulled up before add up to $4,800 a month. The monthly expenses on this property are going to be $3,923. So that leaves me with a monthly cash flow of $876. Now again, we can say, well, LJ, you didn't include landscaping, you didn't include maintenance, you didn't include reserves, you didn't include anything like that. I didn't have to include heating and electricity because the tenants are paying for that, but we did not include the other things because this is really a quick calculation to see, is it cash flowing from a base standard, if you will. And in this case, yes, obviously we have more than enough, and it's actually leaving $10,514 annually. So that is more than enough for the reserve, for repairs, for things that were to come up. It's actually a very healthy cash flow for a property, especially off the hop, not having to invest anything right away. If we look at this, I have my total cash invested, and this is $188,501. And what I do here is it's your down payment plus the closing costs. In closing costs, I have $1,000 for inspection. I've got $2,000 for notary fees. I've got adjustments, which is just half your taxes because those are prepaid. It'll be adjusted. And in this case, because it's a revenue property, if you close early enough in the month, it's going to be almost negligible or even in your favor because you're going to have the rent adjusted for you as well. There's no CMHC tax in this first scenario because we're putting 20% or more, so we don't have to go through the insurer. And we have a welcome tax of $8,875. This number seems a little bit low to me. I'm going to double check it after, but it gives you a rough idea of what you could do in terms of welcome tax. So all in all, this is now looking at $13,701, which is where we get the addition to that total cash invested of $188,000. So as we can see here, the total cash invested is $192,576, and my cash on cash return is calculated by dividing the yearly net revenue, so it's $10,514, divided by this total cash, which gives me that 5.46, which is an excellent cash on cash return for property in Montreal off the hop without looking at anything else. Now, if you're wondering how I got to this total cash invested, all I did is I took my down payment over here of $174,800 and I added my closing costs. If we look at the closing costs, we have inspection for about $1,000. We've got notary fees for about $2,000. I've got adjustments for $1,800 and change here. Now again, if you do close earlier in the month, you're gonna have the rents adjusted in your favor. So it's actually gonna be even less or possibly even entirely positive in your regard. And then I have a welcome tax here about $12,000, just under $13,000 to give you a rough idea. Now, if we do look at scenario 2 over here, where you were buying it with 10% down, we still have an excellent investment over here. And given the fact that you've only invested $87,400, and we do have the CMHC to tack onto it, we have amortized now over 25 years. The fact that this property still cash flows, albeit barely, we're looking at $59 a month, is an excellent opportunity. Now, obviously your cash on cash goes down to almost nothing because we've still invested about $105,000. But the fact that you've purchased a property for $105,000 invested into it and that you are breaking even off the hop is an excellent opportunity, because one thing that we don't talk about in real estate a lot of the time is the fact that regardless of how much you invest at the time of your purchase, the appreciation is going to be the same. So if you buy a property for $874,000, it doesn't matter if you put the whole thing in cash or if you just put $100,000 in cash at the time of purchase, the appreciation growth is going to be the same. Therefore, the less you can put into it upfront, the greater percentage return you're going to have on that. So that's something else to consider. If you can keep your cash on hand and potentially buy 2 or 3 properties, that becomes a pretty interesting strategy for diversification. So this gives you an idea of what you can do with a property and what I look for when I'm doing a quick calculation, and a couple of the different formulas and that we looked at earlier today. Finding a profitable real estate deal in Montreal isn't just about location. It comes down to a few more factors. Like I said in this video, you want to make sure you know your numbers. You want to understand what the market trends are like. And you want to make sure you know your calculations. We looked at cash flow, we looked at ROI, we looked at cap rates. The more you know, the better prepared you're going to be. And one thing we didn't speak about, but I will mention now briefly, is understanding rental potential. So it comes down to really knowing your neighborhood, and once you understand the rental potential of the neighborhood, you can become a wizard at running pro formas and understanding where you can have the biggest optimization potential. If you like what we spoke about in this video, and if you got some value from it, please throw me a like or subscribe to my channel. I put out weekly videos all talking about real estate in the greater Montreal area. If you are looking to start your journey in investing, or if you want to work with a broker who specializes in this, I've done this for myself and I've done this for lots of other clients, feel free to drop me a line, just hit me with a comment down below, or simply book a meeting with me. Like I said, I'd be more than happy to help you with your journey. Thank you so much for watching this video. I look forward to seeing you on the next one.